Welcome to the Balance Blueprints podcast, where we discuss the optimal techniques for finances and health, and then break it down to create an individualized and balanced plan. I'm your host, Justin Gaines, here with my co-host, John Prover. In this episode, John and I discuss retirement accounts and asset allocations, how they should be adjusted based on your risk tolerance and your age. Thank you for listening. We hope you enjoy. And then we're going to talk about diversification of your retirement accounts and why that's so important. And I actually just emailed a client about this, so I am going to pull that up from my notes because I feel like I summarized it well. I'll know better when the client responds if I summarized it well. But the key part here is that whenever you're investing for retirement, you're always going to think about your risk tolerance. Everybody always asks you what's your risk tolerance. And we both know from our relationship that I have a much higher risk tolerance than you do, even though we're the same age. Mm-hmm. And that's where the risk of just because we're the same age or in the same age bracket, that doesn't mean that we have the same risk tolerance. Right. So a lot of this blanket financial advice isn't good advice for your specific situation if it doesn't match your risk tolerance. So one of the exercises I use with my clients to very easily determine like what your risk tolerance is you'll ask yourself, if I had money in the stock market, and for just easy round numbers, we'll say I have $100,000 in the stock market, and tomorrow it goes down 50%. Mm-hmm. So I had 100, I put 100 in, now it's at 50. Mm-hmm. Do I want to get out of the market in that situation and say, like, this is not for me, way too much risk? Do I let it sit there and build over time? Or do I want to buy more and put more money in hopes that I can buy it at a discount and it'll grow faster because of that? The way you respond to that will help you in determining what your risk tolerance is. Mm-hmm. And so if you pick option one that you want to pull out, you have a lower risk tolerance. If you would set it there and just ride it out, that's a moderate risk tolerance. And then and low we would say is conservative. Mm-hmm. Middle of the road we'd say is moderate. And then if you're somebody who's like, oh, I'm going to put more money in and hopefully I'm buying at a discount and we'll go from there, that's somebody who's a little bit more risky. So you tend to fall in the conservative to moderate category, and then I definitely fall into the risky category.
Yeah, I think I've at least learned enough at this point where like my initial thought when you said that was, I got to leave it in because if I sell, I lose that. So like that was my at least initial thought. So we've moved slightly towards
right, and that's why I said when we first met, you were definitely
the fear
conservative. Yeah, you would have invested like a 7-year-old man when we first met. Yeah, but now you're falling into that moderate category, and it's one of those things that as you learn things, you will move into what I call your more appropriate risk tolerance. Because another portion of your risk tolerance, and why I say appropriate, is most financial advisors will keep you within a certain range of your risk tolerance. And that's because a 20-something invests differently than a 50-something who invests differently than a 70 or 80-something. And the reason that is because of time horizon. The amount of time that they have before retirement is longer or shorter, potentially to the point where it's even zero. Mm-hmm. And so when they need that money and what the time horizon is for each dollar in their account is on that range. And the reason that range is important is most retirement accounts are invested into the stock market. And the stock market's the number one area that people go to and invest in. But as we know, the stock market goes up, goes down, goes sideways. It's very volatile. It changes every single day. It's at a different value. It's constantly moving. And so you'll hear people say, oh, you should invest in the stock market because it always goes up. Now, the reason that they can get away with saying that is because generally speaking, if you look at any time period, what I would say is if you look at any 20-year time period, the stock market has increased in value.
Right.
Now, if you look at shorter time periods, the market may have decreased in value. And that is why time horizon matters. Is because if you are trying to time the market, you don't know if it's going to go up, down, or sideways. And if you do, give me a call because we need to talk.
Yeah, that's fair.
You know what I mean? Because you would be the wealthiest person out there because you'd be, shorting stocks in the down market and buying everything up and going from there, and your upside potential would just be massive. But nobody has that crystal ball. Nobody has the ability to do that. They usually call that insider trading, which is illegal.
Which does happen.
It does happen, but don't give me a call if you're doing insider trading because I don't want anything to do with that. But if we look at averages, that's really the only thing that we can do is we can look at, 80, 100 years of stock market history. Let's look at averages. Mm-hmm. So we'll talk in terms of bear and bull markets today. Bear markets are when the market's going down. Bull market is when the market's going up. And so your average bear market lasts 1.3 years. So that's 16 months. Your average bull market lasts 6.6 years. So, 6.5, a little over 6.5 years. Mm-hmm. Now, what that means is that, and that's why, because of those time differences, that's why over time the market has just continued to increase.
Right.
And I believe during those bear markets, it's been a 38% decline on average. But during the bull markets, it's like a 336% incline.
Right.
Now, part of that's because, if you looked at year over year, so that's the total during those time periods. If you looked at year over year, what the rates of return are, while one's positive, one's negative, they're probably going to be a lot closer in values. Mm-hmm. And that's because one's over 1.3 years and one's over 6.6.
Right.
So when you're looking at your time horizon, if you're going into retirement, you want to avoid a bear market as much as possible. Because if you have $1 million and it goes down, we'll round up and say it's 40% decrease. If you have $1 million and it goes down by 40%, that's $600,000. Now, to get back to the full million, you need an almost 80% return to recover from that. So really the question becomes, in a bear market, how long does it take to get back to even? Mm-hmm. And on average, it's 19 to 24 months. So around 2 years, just under to at 2 years.
Yeah.
Which means from the start of a bear market to break even, the point at which it goes down, so you started here, the point at which it goes down, and to get back to where you were is anywhere from 2 to 3 years.
Yeah.
And that's time that you didn't make any money. You just, you lost money and then came back to even, and that's if you don't touch it.
Yeah.
So with my clients, we look at allocation mixes. And every financial advisor, this is not just a me thing. Every financial advisor is going to look at allocation percentages. How much of your investments should you have in the market and volatile asset allocations, and how much should you have in fixed assets or retirement assets that aren't going to be able to have these bear and bull market fluctuations. Typically, those fixed assets, as we call them, will have guarantees or set interest rates that are either FDIC insured or they're backed by insurance companies. It might be bonds, municipal or privately held bonds, but things that have set interest rates, what you're going to make. Now, it's going to be a lot less than what you could make on an up market, but it's also a lot more than you could make on a down market. So you're trying to protect that because you've worked all these years from your 20s until your 50s, we'll say. You've worked all these years, you've had maybe 10%, 20% in fixed assets, 80% in the market. Some people even 100% in the market. But now you're sitting at 1.5, $2 million, $1 million. You do not want to go from $1 million down to 600,000 because you're just now you have 3 years essentially based on averages. You'll have an average of 3 years to be able to get back to even, which is not a good setup. Not a good setup. Even if you're low risk, medium risk, high risk, even if you're a risky person 10 years before retirement, a 40% dip, you may not have the ability to buy in enough, or just the stress of that situation is less than ideal.
Yeah.
And ultimately what we're doing is when you adjust the allocation from a 10 to 20% allocation to in your peak retirement years, you'll have 100% allocation. But as you're increasing that amount is being adjusted as you get older in order to lock in returns so that you lock in a portion of your retirement plan.
Mm-hmm.
Because we know that money's got a guaranteed interest rate. It's not going to go down. We can guarantee that.
Mm-hmm.
It might only keep pace with inflation, but we've guaranteed that portion of it.
Right.
So, like with this client that I'm working with, they're in that 10 to 15 years from retirement, depending on if they want to retire at, 65 or 70.
Mm-hmm.
And so we're looking at adjusting a portion of their accounts into these fixed accounts because they have enough. If they retired today, they wouldn't have enough money to get through retirement.
Right.
But if they retired in 10 years with the same dollar amount that they have now, they would be slightly underfunded. But if we get that fixed asset rate of return on their accounts, they would be funded completely and have no issues retiring. So with that situation, they don't need to get those market rate of returns on all of their money because they're pretty much golden and they're set.
Right.
And so if we run some quick numbers, we'll say that they have 1.2. So if their current market value is 1.2 million and the market turns bear, say in December. So it's because we're still in a pretty good bull market right now from going up. Say it turns bear after the election in December, right around Christmas time, it goes bear. If that were to happen, end of 2024, they'd be at 1.2. We're saying they'd be at 1.2. They'd probably be a little bit above that, but we don't know what rate of return they would get from now till then. So we just say they're at 1.2 December 24. By April of 26, if we're looking at averages, that 1.2 will have gone down to 745,000. And it wouldn't get back to 1.2 until January of 2028. And so that would mean from December 24 to January 28, a 3-year time gap, you would not have made any money. You would just stay completely flat.
Yeah.
Now the opposite is, but what about a bull market? I could have been up during all of those years.
True.
Yes, absolutely. But what I always say to my clients is you could. But could you retire at 745,000 in investment accounts? In this individual situation, it would be very, very tough to do and fully fund the retirement accounts. And in most people's situations, it would be very, very tough to do and fund their retirement accounts. And so what I've proposed with this client is that we move 75% of this into a fixed account, but still leave a quarter of it in the market. Now, if we did that, what do the numbers look like? So we still have 1.2 in December 24, but it would only drop down to 1.1 by April of 2026. So instead of losing 355,000, we'd only lose 100,000. And then at the same time period where they normally would have broke even, and they would have been back to 1.2 in January of 28, they'd be up to 1.35. That's in a down market.
Yeah.
In an up market, they still would have, since we're using a 75% number, of that 1.2, this I didn't put in the email, so let me just quick calculate this. So they'd still have $300,000 that is in the stock market that they're able to get rate of return on. And so they're still going to get their, 3-4% on their fixed asset, not taxed, still in their retirement accounts, still growing, tax deferred. That's still going to increase steadily. And so in a bull market, say it doesn't go bear, it maintains bull, they're still going to get those massive rate of return on the 300,000. And so now their 1.2 might go to 1.4, 1.5 by, that 2028 number.
Right.
But they're still in a down market, they're not impacted. And an up market, they're only positively impacted. Yeah. And that's only because of asset allocation. They can still be as risky as they're being now in that 300,000 that's still in the market. But by adjusting your asset allocation because of their age and because they're 10 years away from retirement, adjusting that asset allocation and just taking 75% out of the market, leaving 25% in, they've now secured their downside risk and now have the ability to continue to make upside if they'd like.
Yeah. Yeah. For me, that's a great middle ground. I mean, again, as we talked about at the beginning, switching more into a moderate middle ground type response. That's just best of both worlds of where I'm secure, and that still gives me some, I won't kick myself of like, oh, I pulled everything out. But if it does go down, I'll be glad I secured some. And I mean, but I imagine some people get really stuck on that number of, well, if it is an up market and I don't, put any in fixed, well, instead of 1.5, I could be at 2 million. But, it's like at your age, and it just comes into, I guess, greed of like how it's not like greedy in a sense that you want to take from others, but how much do you need to make when like you're all set? So why do you need more than you need?
Right. And ultimately, not understanding risk tolerance and not understanding these numbers is what drives people to not play with their asset allocation properly. Mm-hmm. They're thinking, yeah, but my upside potential is this, my upside potential. Okay. But the problem is that if you take, in my opinion, the 10 years before and the 10 years after retirement are your most important years, because it's where you can lock up and guarantee that you know how retirement's going to go, mm-hmm. and make sure that you have that security like we potentially will do for this client. Or you play the gamble game, and we're talking averages here. So if the average is 6.6 for an up, 1.3 for a down, and 2 to get back to level, say that it runs that cycle. It's 6.6 up, 2 typically would go up, down, and then flat, back to flat, and then mm-hmm. back up again. So say it's 6.6 years, down 1.3. So now we're at 7.9, and then takes another 2 years to get back up. So there's your 9 years. Your 9 years is a cycle.
Yeah.
And so that's why I'm saying your 10 there, your 10 before, your 10 after are the most important, because most retirement accounts, if you only, in that 20-year period, if you only have 2 bear markets, your retirement accounts generally will be okay. Mm-hmm. Because the amount of increase that you had prior to the decrease and then back to even, doing that twice still puts your accounts well above where you need to be at for retirement, assuming that 10 years before retirement, you were at a position where a healthy conservative rate of return would have funded your retirement. Mm-hmm. If that is your scenario, 2 down markets, the numbers show, don't negatively impact your retirement. 3 down markets, though, can reduce your retirement income by 20 to 40%.
That's huge.
And that's your income for all of retirement can be reduced by 20 to 40%, which for some people could be the difference between being able to retire and not being able to retire.
Yeah.
If we say, okay, we have enough here, let's adjust our allocation to 75-25, and you have an up market, your allocation naturally, because your investments in the market are going to outpace what you had allocated. Proper financial planning would suggest that you should then take out of your $300,000 that grew, you should take a portion of that to rebalance your account to a 75-25 split.
Yeah, that makes sense.
But what I would tell a client that is very risk tolerant is, we did the calculation and we know that 75% of the old account balance was sufficient.
Right.
You don't need to move this amount over. You should, if we're following, maximizing your retirement, maximizing your guaranteed income in retirement, we should reallocate. However, if you want to play it more risky, in my opinion, that is when you play it more risky.
Yeah.
When you've already balanced the account, you already know that you're going to be okay in retirement. There's an opportunity here to potentially be better off. There's also an opportunity to, because we've already guaranteed our level, there's not really an opportunity here where if we take on more risk, it's going to negatively impact us. Yeah. It's only going to negatively impact us from the new level of high that we're putting at risk. Yeah. We've already secured our floor. And so if we then go to a 60-40 split, it's not as much of a concern because the 60%, while it's a lower percentage, it's a lower percentage of a larger pie, is still the amount of money that we need in order to guarantee the retirement.
It's funny because I feel like this concept, and I'll probably fumble through this, but this concept is understood if, say, someone is younger and they have a lot of debt and they haven't paid off their debt and they're like, oh, okay, well, I can't afford to buy, I should say not everyone, but I can't afford to buy a brand new car. But it's like we get into, it's like my basic needs aren't covered yet. So I shouldn't spend extra than I need to. Like maybe I should buy a used car. And as I'm saying this, I know a lot of people don't do that. Actually, they get leases and overspend. But point being is I feel like it's easier to understand in that scenario than like, oh, in retirement, I have this collection of money. I just have so much right now in general, even though I can't touch it. It's like same philosophy. It's I should secure my basic needs. And then, yeah, play with any money you want. If I lose all of that, I have my basic needs covered. And it kind of sucks, but I'm okay.
The hardest part for most of my clients when they're younger is that they don't understand how the market operates and they don't understand how to get into the market. But then if they've gotten into the market and they're closer to retirement years, they've seen how the market's done over the last 30 years. And they try to say, and it's confirmation bias, they look at the market and they say, it's done this much over this time period. Why would I get out of this? It's done so well for me.
Yeah, it makes sense.
That's the same argument, though. We'll use the car analogy. Say you bought a car brand new, you've taken really good care of it, and you've kept it for 10 years, and it's treated you really well. And you have an opportunity to buy another car at a really great price. Say it's an identical car, identical make model. It's just upgraded 10 years, but it's the identical quality, identical vehicle. It would be the equivalent of saying, I don't want to get rid of this car because it's taken me and my kids to all the sports games, to all the dance recitals, to all these great things. Why would I get rid of this car? I have so many memories with it. It's done so well for me. But we know with the car that if I hold on to this, eventually it's going to break down.
Right.
The same is true in the stock market. Eventually, the market is going to correct. Always. If you look at historical, 6.6 years up, 1.3 years down. And so what we don't want to do is we don't want to try to time the market. And that doesn't matter what your age is. You should never be trying to time the market. If you're trying to time the market, everybody who tries to time the market loses money. If you want to talk to a day trader and you have a day trader who's trying to get you into day trading, all day trading is trying to time the market. All you have to ask a day trader to get them to be very upset with you and not know how to respond and just blow up and just be very upset is ask them what their compounded annual growth rate over the last 3 years is and ask them what their compound annual growth rate over the last 5 years is. There is not a single day trader in the world who has performed consistently over time. Not a one. Because you can't time the market. Yeah. If you could, you would be a gazillionaire.
Yeah. Well, I think that's a perfect analogy because even say the car doesn't break down, but you decide to keep it and you get hit by another car. I mean, that's what COVID was. It's like there's even outside variables
right.
that like.
So, right, that you have no control over. Right. And so my argument with the allocation piece is keep the car. It has a bunch of memories. Keep the car. Maybe it's a collector car and it's got value. So, and maybe it's not a collector car. It's just one that you have a lot of emotional attachment to. Put it in the garage, drive it a little bit, keep it around, but have something else that's going to guarantee you safety, transport, ability to get from point A to point B, ability to get to your medical appointments, something that is reliable and has a minimal chance, if any, of breaking down.
Just sell everything and buy a crotch rocket. But
and you can do that in your 20s. You can buy a crotch rocket in your
20s. That's true.
Because if you end up, losing a leg, you have the ability at that time period to learn how to walk again.
I know.
But with an amputated leg.
Yeah.
You don't have that ability when you're 50, 60. It's not that you don't have the ability. It's going to be much more difficult. Going to be much harder. The same philosophies are true in your retirement accounts.
So my only other question I guess I have is, I know we kind of talked about that 9-year window, and I know we're not supposed to time the market, but could you make more or less risky situations based off, I mean, if on averages it's 9 years, couldn't you see like bigger cycles? So not like short timings, but longer timing.
So that's why we want to start, and that's why I say a 10-year window before and after. So a 20-year window, but 10 years before, 10 years after. And the reason being is that we do want to do that. In my opinion. In my opinion, you want to look 10 years before your retirement. We want to look at how much of the account you have and what the market's doing and where we think the market's going to do. And we have that conversation with the client. You know, what does the client think is going to happen with the market? And then based on what they think is going to happen with the market, that's how we determine, is it a 60% allocation to fixed assets or is it an 80% allocation to fixed assets? If we think we're going into tumultuous times and the market's going to be crazy, we're going 80% fixed assets.
Right.
But if we think, you know, we're at the beginning of some really good years here and the market's going to do great, I think, for the next, 3 to 5 years, go with a 60% allocation.
Right.
And then that way you have more in the market, but we've still guaranteed 60% of our retirement.
So you're not timing it in a sense of day to day, month to month, and I'm dumping all my funds in it. You're timing it in a sense of what stage is it in, and I have to allocate some. So what percentage?
Right. And it comes down to, and the percentage mindset is, it's a risk management technique.
Yeah. You
want to look at, with what degree of certainty do you think the market's going to go up? And then how much do you think it's going to go up? Because this is what financial advisors are doing with their own money, is we sit here and we go, okay, in the next year, do I think the market's going to go up, down, or sideways? And then you apply a percentage to it because we don't know for certain.
Right.
So like right now, I would say, between now and the end of the year, I think the market will go up, and I think I have a 70% certainty of that. And then I'd say, maybe there's a 20% certainty of it being flat, and there's a 10% certainty of it going down. And then assign values to that percentage. I think, up is 10%, flats obviously is 0%. And then down, if it goes down, maybe it'll go down, we'll say 10%. That makes it really easy. You can then multiply those percentages and see what you anticipate the market to be. 70% times 10 is a 7%, 0, and then 10% at 1. So you think that on average, based on your calculations, you're saying the market's going to go up 6% based on your degrees of certainty. Based on your degrees of certainty, you can then look at asset allocation percentages into those accounts to see how that projects over time.
Right.
That's very high level, and you want to have a financial advisor walk you through those conversations if you're going to have them. But that's why I want to catch you 10 years before retirement.
Yeah.
Is because if I catch you 10 years before retirement, if you're at 100% in the market and you're 10 years before retirement, we're gonna make some sort of change. Yeah. Maybe it's a 50-50 split, maybe it's a 40-60 split. We're gonna move something into fixed assets.
Yeah. That makes sense.
But the question becomes what percentage, and that's going to be dictated based on what we think the market's going to do over a long period of time. We're never trying to time the market over a short period of time. We're doing it over a long period of time, and we're still putting a degree of certainty of it's not going to work out how I think it's going to, and then allocating towards that. Because realistically, that you're doing the same thing with even a 75-25 split. You're still saying, you're ultimately at that point in time, we're concerned about down markets, but we're still saying the market has a higher percentage on average to go up than it does to go down. So let's leave some money in there that if it goes down, it's not going to greatly impact us, but it has the potential to impact us positively if it goes up.
Right.
And then if the market goes down, we leave it in there and we allow it to self-correct. But if it goes up, we reallocate and we take some of those earnings and move it into the fixed asset, and we just harvest that. We just harvest the fixed asset earnings over and then allow it to keep going. And because we have a long time horizon, if it goes down, it's no concern. Because on average, it's going to go down for 1.3 years and back up in 2 years. So in 3-year time frame, 3 to 3.5 year time frame, we'll be able to get back to ground zero. because we have 75% of the money over here, we can take distributions of income retirement out of the 75% and allow that money to have 3 years to get back to even.
Mm-hmm.
But if we have everything in the market and the market goes down 10%, we're not going to get back to even in 3 years, because we have to continue to take retirement draws out of that, which is compounding our decrease in value.
Yeah.
So it allows us, we're buying time horizon by doing an asset allocation into fixed assets.
Yeah. It seems like a great strategy, great middle ground, because you can adjust based on risk tolerance.
Right. And that's why it's, this is, asset allocation is the number one most important topic as you build your retirement accounts.
Definitely.
Funding them in the initial stages is the number one most important thing. Number one, once you've actually started investing, is your allocation percentages.
Oh. Sweet. Anything else?
That's the basics on asset allocation, I think.
Thanks for listening to our podcast.
We hope this helps you on your balance freedom journey.
Please share your thoughts in the comments section below.
Until next time, stay balanced.